Book Summary: The Psychology of Money. Author, Morgan Housel. Chapter 1, No One is Truly Crazy. The way each person perceives and uses money is the result of a series of unique personal experiences. No two are exactly alike. No financial behavior is entirely irrational when placed in the context of the life of the person making the decision. Someone who grew up during a period of high inflation, when money lost value monthly, will believe holding cash is foolish. Meanwhile, someone who witnessed their parents lose everything in the stock market will view financial markets as a scam. Neither is wrong, they are simply acting based on their individual memories of risk and reward. Take Ronald Read, a janitor who lived frugally and quietly invested in stable stocks for decades. He had no college degree, no finance background, yet left behind an $8 million fortune when he passed away. In contrast, Richard Fuscone, a former senior executive living in a multi-million-dollar mansion, went bankrupt after the financial crisis due to excessive borrowing and overly aggressive investments. Two people, two worlds, two entirely different approaches, yet both were rational given their circumstances. It's the differences in experiences that create differences in how they handle money. No one is crazy when it comes to money. They are simply living by the rules their lives have written for them. And that's what makes learning from others complex. No one is playing the same game. Understanding this helps us judge less, and start making financial decisions that truly suit ourselves. Chapter 2, Luck and Risk. Not every success comes from talent, and not every failure stems from ignorance. In the financial world, luck and risk are two invisible but powerful forces that heavily influence individual outcomes. The danger is that we often only see the results, not the path that led to them. Some become wealthy by investing in a booming industry at the right time. Others lose everything because the market turns just after they invest. Both may have done everything right, yet their outcomes differ vastly. Judging behavior solely by results can lead to praising the lucky and condemning the unlucky, a deeply flawed perspective. Bill Gates' story is a clear example. He was a genius, but his access to a computer at Lakeside High School, a rarity in 1968, was a unique factor in his early success. Meanwhile, his best friend, Kent Evans, considered even brighter, died in a mountaineering accident at 17. One became a billionaire, the other never had a chance. Results don't fully reflect ability or choices, they also depend on variables beyond control. Similarly, many investors go bankrupt not because they were wrong, but because they hit a bad moment. Conversely, some win big simply because risks didn't materialize at the wrong time. If others mimic their behavior without understanding the context, they might be copying luck, not skill. Recognizing the role of luck and risk isn't about excusing failure or denying effort, it's about staying humble in success and avoiding harshness toward others' failures. Don't emulate winners without understanding why they won. And don't underestimate losers just because they were unlucky. Chapter 3, Never Enough. People often don't know where to stop, even when they have what others dream of. Rajat Gupta, former McKinsey director, is a stark example. He had a stellar career but, wanting to be even richer, committed insider trading and paid the price with his reputation, career, and freedom. His tragedy is all the more bitter because it was entirely avoidable, if only he knew enough. Joseph Heller, author of Catch 22, was once asked how he felt facing a young tech billionaire who earned more in a few years than Heller did in his lifetime of writing. Heller simply replied, "I have something he doesn't, I know what enough is." That realization grants a freedom money can't buy. Many trade valuable things like honor, peace of mind, or family time to chase a finish line that doesn't exist. Happiness doesn't come from climbing higher but from knowing when to stop. Contentment stems not from what we achieve but from feeling satisfied with what we have. Yet modern society fuels consumption, comparison, and competition. Each step forward becomes the foundation for bigger expectations, creating a vicious cycle. A person might start with a simple goal, like buying a house, then want a mansion or lavish vacations. Without awareness, no limit can curb desire. The key is to set personal boundaries for greed, define your own enough, and commit to it, because without that, you'll never stop. Chapter 4, The Miracle of Compound Interest. The power of compound interest comes not from speed but from time and consistency. It's not a get-rich-quick trick but the foundation of sustainable wealth building. The longer it operates, the more extraordinary the results. Ronald Read, a janitor and gas station worker, quietly invested in stable stocks for over 50 years. When he died, he left over $8 million to a local library and hospital. Remarkably, he didn't have a high income or complex strategies. He simply invested early, consistently, never withdrew, and let time do the rest. In contrast, many professional investors achieve impressive short-term gains but lose everything due to impatience or trying to control too many variables. They don't give compounding time to work, disrupting it by chasing performance. Financial success doesn't require exceptional returns. It demands maintaining a good enough approach for a long enough time. Like planting a seed and watering it regularly, compounding requires persistence, not genius. Warren Buffett's wealth, mostly accumulated after age 60, stems from investing continuously for over 75 years. In finance, it's not the fastest who win, but those who survive the longest. Chapter 5, Getting Rich is Hard, Staying Rich is Harder. Getting rich requires boldness, staying rich demands humility and caution. These are distinct skills that don't always coexist in one person. Someone might earn a fortune through confidence, daring, and risk-taking. But without vigilance, that same person can lose it all by failing to protect their gains. Jesse Livermore is a vivid example. He was Wall Street's most famous speculator, earning millions during the 1929 crash through short selling. But years later, he lost everything by continuing to make big bets and failing to exit when the market turned. He died in despair, despite once being hailed as an investment genius. Many lottery winners or early career successes face similar fates. They get rich quickly but can't sustain it. They spend lavishly, invest recklessly, live as if invincible, and face bitter consequences. Statistics show most lottery winners lose nearly all their wealth within a few years. Staying wealthy requires a defensive mindset, knowing you can be wrong, saving for tough times, and never betting everything on one outcome. Sustainable investors build protective layers, financially, mentally, and even in their beliefs. Surviving over time, through crises, is the true measure of financial success. Chapter 6, The Long Tail. Most results in investing and life don't come from evenly distributed efforts but from a few exceptional actions or opportunities. This is the long tail phenomenon, where a handful of correct decisions create the majority of value. In investing, a venture fund might back hundreds of startups, but just one or two, like Facebook or Google, generate all the profits. The many failures don't matter if the successes are big enough. Similarly, an individual investor doesn't need to be right all the time, just spectacularly right a few times to transform their financial outcomes. This pattern appears in art, science, and careers. A scientist may publish dozens of studies, but one breakthrough invention creates global impact. An artist might release hundreds of songs, but one hit defines their legacy. The smart strategy is to accept many small failures to preserve the chance for a big win. No one knows in advance what will yield massive value, so maintaining consistency, patience, and resilience through setbacks is critical. The long tail isn't for the impatient, it's for those persistent enough to wait for their moment. Chapter 7, Freedom. The greatest value money can offer isn't luxury or status but freedom, the ability to control your time and live life on your terms. The happiest people can work when they want, rest when they need, and avoid being dictated by others' schedules. A sociological study shows those with time autonomy are often more satisfied with life than those with high incomes but little control. Having lots of money doesn't guarantee freedom. In fact, many wealthy people become more dependent on jobs, clients, reputation, or social expectations. Time freedom is an intangible asset money can buy. It's not about doing nothing but having the choice to act or not. Someone with average income but control over their schedule, who doesn't need permission to take a break, may live happier than someone earning triple but drained by pressure. Owning freedom is the foundation of ease and peace of mind. Thus, earning money should be a tool to gain control over time, not a new shackle. Freedom isn't in the bank balance but in the ability to choose how to live each day. It's the power to say no to what you don't want and yes to what truly matters to you. Chapter 8, The Car Guy Paradox. The value of money lies not in making others admire you but in granting control and personal freedom. Yet many spend money just to impress, hoping to earn respect, affection, or admiration. This is a common paradox. The man driving an expensive sports car thinks others will admire him, but in reality, they're only focused on the car, imagining themselves behind the wheel. The author argues that most things we buy to show off, watches, cars, designer clothes, don't achieve the deeper goal of making others genuinely like or respect us more. Instead, admiration is directed at the object, not the person owning it. This creates a futile cycle. The more we spend to be recognized, the more we tie our self-worth to others' gazes. The solution isn't to reject consumption but to understand the motives behind our actions. When you realize true respect comes from behavior, kindness, and humility, not possessions, you gain freedom in your choices. Living simply isn't about deprivation, it's proof of confidence and clarity in your own worth. Financially savvy people don't need to prove anything through what they own. They let their actions, character, and lifestyle speak for them. In a world full of consumer illusions, this is rare wisdom. Chapter 9, Wealth is what you don't see. True wealth isn't in what you display but in what you choose not to spend. While society often judges wealth by visible signs, luxury cars, expensive watches, mansions, the greatest wealth is hidden in restraint and financial discipline. Someone driving an ordinary car but with substantial savings, little debt, consistent investments, and living below their income is truly wealthy. Yet they often go unnoticed because their assets don't make an immediate impression. Meanwhile, those who spend extravagantly may only be burning through income, or worse, borrowed money, to maintain an image they think is necessary for respect. The author emphasizes that wealth is assets not spent on liabilities. Saving, investing, and not overspending are the behaviors that build real wealth. The difference between rich and appearing rich is something many fail to distinguish, leading to flawed financial choices. Wealth is the ability to choose, the freedom and security for the future, not the image in the present. Understanding this reveals that simplicity is not just a virtue but a powerful and wise financial strategy. Chapter 10, Saving Trumps Investing. Saving is the cornerstone of personal finance and often more critical than investment strategies. While investing depends on markets and external factors, saving is entirely within your control. It's the most proactive step in the journey to wealth. Many focus too much on investment returns, optimizing portfolios, tracking daily fluctuations, while overlooking that increasing savings is a simpler, surer way to grow wealth. Someone with average income who saves consistently can become wealthier than a high earner who spends recklessly. This shows that wealth gaps stem not just from income but from spending habits and self-control. Saving is not just an economic act but a reflection of humility and independence. It shows you're willing to live below your means to gain future options. Savers build a financial buffer that keeps them steady through crises, allows them to avoid risks, and frees them from making decisions under financial pressure. Sustainable wealth starts with saving discipline, not complex investments. If choosing between an optimized investment strategy and a healthy saving lifestyle, saving is always the easier and more immediate impact. Chapter 11, Reasonable over Rational. Personal finance doesn't always follow mathematically optimal principles. In reality, people often make decisions not because they're the best theoretically but because they bring peace of mind in their lives. This is the difference between rational, doing what's logically optimal, and reasonable, doing what suits your emotions and circumstances. For example, paying off a mortgage early isn't optimal if interest rates are low and the money could earn more invested elsewhere. Yet many choose to do so because it offers security, mental comfort, and a sense of freedom. That's a reasonable decision, even if not rational by financial standards. A family keeping $50,000 in cash might be deemed inefficient for not investing, but for them, it's a safety net that prevents panic during market swings. That's worth more than a few percentage points of expected returns. The author stresses, the goal of personal finance isn't to maximize returns but to make decisions that let you live calmly and sustain healthy habits long term. If a financial choice helps you feel stable, avoid panic, and stick with your investment strategy, it's reasonable, even if it's not the highest yielding option on paper. Understanding that finance is a personal story helps you avoid the pressure to act correctly by other standards. Reasonable, rather than rational, is what keeps you committed to your unique financial path. Chapter 12, Surprise. In finance, the only certainty is uncertainty. The world never follows a fixed script. Markets, technology, policies, and human behavior constantly shift, often in unpredictable ways. Events like the 2000 dot-com bubble or the 2007 housing crisis show how unexpected shocks can ruin seemingly perfect plans, not due to a lack of intelligence but a lack of preparation for uncertainty. To cope, build financial strategies with a margin of error, meaning reserves, diversified risks, and maintained flexibility. This includes diverse investments, emergency funds, avoiding debt, and not getting greedy when markets soar. A good strategy isn't one that maximizes returns but one that survives long-term through shocks. Rather than predicting the future precisely, wise investors focus on adaptability. Successful investors aren't always right, they're quick to adjust when reality diverges from expectations. Humility, accepting you can't control everything, becomes an essential asset. In short, surprises are an inevitable part of life and finance. Preparing mentally and strategically for the unpredictable is how to build a resilient financial foundation capable of weathering any storm. Chapter 13, Margin of Error. One of the most vital principles in finance is always leaving a margin of error, a buffer that keeps you from collapsing when things don't go as planned. The world is full of unpredictable factors, and even correct decisions can lead to bad outcomes due to changing circumstances. Thus, the ability to survive, rather than optimize, is paramount. The author compares a financial strategy to an airplane needing multiple engines. When one fails, the others keep it flying. Similarly, maintaining emergency funds, spending below income, investing cautiously, and diversifying portfolios are backup engines that help you navigate crises without heavy losses. A margin of error also reflects humility, acknowledging you can't predict the future perfectly. Wise investors don't aim to be perfectly right but build plans flexible enough to remain stable even when wrong. This lets them survive long enough for compound interest and long-term strategies to take effect. In investing, survival is victory. Instead of asking, "How much can I earn?" ask, "Will I be okay if things go worse than I expect?" That answer is the bedrock of any sustainable financial strategy. Chapter 14, You Will Change. One of the simplest yet often overlooked truths in personal finance is that people change. What you deem important today may hold little meaning in 10 or 20 years. Yet when planning finances, many assume they'll forever pursue their current goals. The author shares a personal story. He once aimed to be a professional investor, working at big firms, chasing maximum returns. But after starting a family, he realized he valued flexibility and free time above all else. His financial goals shifted from maximizing wealth to building a stable, fulfilling, low-stress life. We often look back at past decisions with shame or judge ourselves harshly. But that's unfair, we're using a different version of ourselves to judge. Change is an inevitable part of growth. The key isn't to always be right but to stay flexible enough to adapt as you mature. When designing financial plans, leave room for change. Don't lock yourself into a rigid path. Allow yourself to shift goals, strategies, and even your definition of success over time. Chapter 15, Nothing is free. In finance, as in life, everything has a cost. But uniquely, this cost is rarely spelled out like an invoice. It might be anxiety, uncertainty, waiting time, or sleepless nights when markets crash. These are invisible but real costs you pay for long-term rewards. The author likens stock investing to the most thrilling ride at an amusement park. Everyone wants to play, but to do so, you must wait in line, endure frustration, and have time. Similarly, to reap the benefits of compound interest and long-term growth, you must endure crashes, price swings, and moments of wanting to quit. Many fail because they refuse to pay the price. They think they can invest without worry, time, or sacrifice. When volatility hits, they panic and bail, not because their strategy was wrong but because they wouldn't accept the accompanying cost. Financial success doesn't come from avoiding risk entirely but from understanding what you're paying for, and being willing to pay it. Once you accept that emotional turbulence and waiting are inseparable from the investment journey, you stop seeking shortcuts and learn to stick with the right long-term strategy. Chapter 16, You and I. One reason many make financial mistakes is that they emulate others without realizing those people are playing a different game. Everyone has unique goals, time horizons, risk tolerance, and personal contexts, but the market blends all their behaviors into one price chart. The author cites an example of a long-term investor reading financial news written by a short-term trader. The information, advice, or analysis may suit the writer but be entirely wrong for the reader if they're pursuing different strategies. This mismatch creates noise and can lead to poor decisions. A stock's price drop might be a buying opportunity for a long-term investor but a signal to exit for a day trader. When all actions mix in one market, it's hard to discern motives. Acting on someone else's logic can derail your own financial plan. The core message is, don't let others' actions sway your decisions too much. Define clearly what game you're playing, what you need from the market, and stick to a strategy aligned with your goals and abilities. In finance, understanding the difference between you and I is the first step to avoiding someone else's game. Chapter 17, The Allure of Pessimism. In finance, pessimistic narratives have a unique allure. They're often seen as realistic, profound, and more credible than optimistic advice. But that doesn't mean they're correct. In fact, history shows that while negative events can strike quickly and leave strong impressions, positive progress unfolds quietly, slowly, and more sustainably. The author notes that pessimism can spur rash actions, pulling money from markets at bad news, shunning opportunities out of fear. Meanwhile, those who stay patient, keep investing steadily, and trust in the economy's long-term recovery often end up winning. Pessimism feels wise because it's tied to caution, vigilance, and savvy. But in finance, dodging all risk means foregoing all reward. Letting fear dominate makes you miss big opportunities. Crowd psychology amplifies grim forecasts, magnifying their impact. The lesson: stay wary of pessimism's pull. Optimism isn't naivete, it's believing things can improve with patience, preparation, and smart action. In the long run, this mindset builds lasting wealth. Chapter 18, When you're ready to believe anything. When facing major financial or life upheavals, people feel uneasy without explanations for what's happening. To fill that gap, we craft stories that sound plausible, even if they're wholly false. The sense of losing control makes us cling to any explanation that restores order. Financial markets are fertile ground for such stories. Whenever stocks soar or crash, a flurry of analyses and reports emerges to explain why. But most are speculation. Markets reflect the actions of millions, each with their own emotions and motives. Many fluctuations are just random. The author recalls his time as a financial reporter during the 2008 crisis. He realized no one could fully explain what was happening. For every seemingly sound argument, an equally convincing counterargument existed. Finance isn't like physics with clear laws, it's a product of human behavior, emotional, illogical, and unpredictable. Instead of always seeking explanations for everything, learn to embrace ambiguity. Sometimes there's no clear reason, and that's okay. Recognizing the limits of your understanding isn't weakness but maturity. This helps you avoid getting swept up in sensational news, stay level-headed, and stick to a long-term investment strategy. Chapter 19, Putting It All Together. After presenting 18 chapters with diverse perspectives, the author concludes by emphasizing, personal finance is a blend of many factors, habits, psychology, time, luck, and individual character. There's no single formula for success, but some universal principles can help you go further and stand stronger. First is humility. Since no one can predict the future, acting cautiously is wise. Don't be overconfident that you'll always be right or that markets will follow your expectations. Second is saving, even without a specific goal. Consistent saving builds a solid financial foundation and gives you future freedom of choice. Third is knowing yourself. Invest in ways that match your personality, goals, and risk tolerance, not someone else's advice. Understanding what game you're playing keeps you from getting caught in comparison traps or acting like someone with different aims. The author advocates long-term thinking, leveraging compound interest through patience and avoiding short-term volatility's pull. Finally, define the game you're playing, ensuring your financial decisions align with personal goals, not others' influence. These principles, though simple, require discipline and self-awareness. By focusing on behavior, patience, humility, and adaptability, you build a lasting financial foundation that navigates markets' complexity and uncertainty, leading to long-term independence and peace of mind. Chapter 20, Confessions. In the final chapter, the author steps away from broad principles to share his personal financial perspective, candidly and without embellishment. He admits most of his financial choices aim not to maximize returns but to maximize peace of mind. He avoids financial leverage, complex strategies, and chasing short-term investment trends. Instead, he saves a large portion of his income, invests passively in long-term index funds, and lives below his means to maintain maximum flexibility. This isn't the optimal strategy technically, but it lets him sleep soundly. One financial decision he highlights is buying a house with cash, despite mortgages potentially offering higher returns. But for him, being debt-free brings greater comfort than any extra profit. This view echoes the book's core theme: personal finance should serve your personal life, not impress others or chase a universal standard. He concludes with a simple message: you don't need to be the smartest, boldest, or richest. You just need to make choices that let you live comfortably, autonomously, and sustainably. In a volatile world, that's a success worth having.